As we are currently living in the craziest mortgage market in the last 15 years, we've also gotten into a time machine a few days in the last couple weeks to revisit rates from the past 2008, 12, 17, and 18 for that matter. We find the Treasury yields straightening up, no more inversions, but we do find housing still all time low inventory with no sign of anything to come that's going to help that. We've got the Federal Reserve setting us up for at least a 50 basis point hike in their next meeting. And to my realtor friends, I may have a very simple answer for you to a very common yet complicated question. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills. I hope you're having a great week. So this is undoubtedly the weirdest time we've had in the mortgage market in a very long time. We have a dislocation, I believe, of about 0.5% premium right now in mortgage rates, in my opinion, based on the fact of the fear of the unknown. Mortgage traders just don't know where interest rates are going to go tomorrow. So to hedge themselves, they've built in about 0.5%, in my opinion, of fear into the mortgage rates. They're also going to be noticing the yield curve, the 2, 3, 5, 7, 10, and 30 are now back in line, and they're sequentially trading, so to speak, with the lowest yields being on the shortest maturities and the highest yields being on the highest maturities, which indeed is a good sign. But as we sit here with this 0.5% of fluff, I'll call it, because of fear in the mortgage rates, this is testing out affordability when it comes to the consumer. I do expect this to settle down, though, naturally, as bond yields maybe have hit their peak, especially on the 10-year, as it has come down in the last few days. On to inventory of this housing market, which is certainly the biggest problem the housing market's going to face, but it is also at the same time the saving grace for values for the housing market. Inventory right now, as I mentioned a few weeks ago, most folks are probably in love with their mortgage that they got in the last few years, so it's going to be really hard to get them to sell their house. Especially in the last few years, if they were going to sell their house, they could essentially swap out their mortgage for just about the same terms they had if they were buying a new place. And as we know now, they can no longer do that. A solution to this housing problem might be when we're all driving around and seeing all the commercial and office space with for lease signs. And I know that a lot of companies are reconsidering their office space allocation. I bet you we'll see in the next couple years, if it hasn't started already, special use permits asked for by developers and builders to maybe try to convert some of this commercial property into residential property, because it is a habitable construction that is there. It obviously just needs to be converted, and that may, in the near future, certainly help out this inventory problem that we have. Now, the Federal Reserve, they are basically the game right now that everyone is trying to gauge. They actually, I want to say this morning, today is Wednesday, had a very hawkish, traditionally, Fed governor come out and say that incremental rate hikes are not going to do the job of fighting the inflation that they're so concerned about and seems to be their biggest concern above and beyond everything else. So I think once again, as we get closer to their May meeting, they are certainly just going to telegraph this. And I'd be surprised if they kept their next rate hike to just 50 basis points. As you know, I mentioned last week, I'd like to see them do all 200 and get it over with. They probably won't do that, but that probably is their best move. So when they are raising rates into a squeezed consumer, it's going to be a great bar trick that they're going to have to pull to not destroy the consumer, which is 70% of the economy, yet fight inflation. So we'll see how they do on that. And that inflation is, of course, one of the four horsemen of the economy that I talk about. I think if you take out food and energy, a lot of things when it comes to inflation that ripple effect out will chill out a little bit. Jobs, we are creating jobs, but I think they are just jobs. They're not careers. I think for a longer term solution, to help wage inflation, people need careers and not just jobs. That plays into the supply chain, the third horseman. That will certainly get figured out when some of the fourth horseman things of geopolitics get figured out. But the supply chain is going to play in with jobs and geopolitics. And that last one, geopolitics. What's been going on in Europe has drawn on a little longer than I thought it would initially. Hopefully this ends soon, but I do know that we should wake up. And there's no reason I should know that the eastern part of a country in Europe grows a lot of wheat, and that's going to affect the price of cereal when I go to the grocery store. And last time I checked, the state of Kansas has plenty of land and plenty of dirt available to farm wheat on. So I think we should start growing our wheat in Kansas again. As I mentioned, this is a national security thing at this point. And then the fifth rail of the horsemen, the Fed themselves. The ironic thing is the Fed, once they deal with all these other things, might have to end up dealing with what they did, which is putting a chokehold on the consumer, in my opinion, which might end up putting a chokehold indeed on the economy. So the fifth rail is the Fed, and the Fed might have to deal in a year from now what they are doing today. And on to my real estate agent friends. So I get this question all the time, and I'm sure you do also. Is this a good time to buy a house? I have two answers for that. Number one, if it's your primary residence, please think of it as a utility, meaning it's just like your cell phone bill, your cable bill, your gas bill, your water bill, your power bill, everything. It is a utility. It puts a roof over your head. So it's always a good time to have a roof over your head. So you're either going to rent or you're going to buy. So the price of rent right now is off the charts. So this is a good time to buy a utility comparatively to renting that utility. Now, if it's an investment property, the way you have to talk to your clients about it is it's a long-term play, and the terms on it aren't going to get any worse, most likely. Don't quote me on this, but most likely than this, meaning these mortgage rates are so inflated right now, especially very dislocated when it comes to investment properties and units, for that matter. The pricing is way too high, in my opinion, given where it should be, given yields, but there's no appetite right now for that kind of paper. But that too will chill out. But if somebody feels comfortable buying an investment property today, the odds are, because this is what's happened for the last 40 years, interest rates will come down from here, maybe ever so slightly, but this is going to be their worst case scenario when they enter the property now, and it can only get better moving forward given they're on a 30-year fixed or a 15-year fixed, the certainty of those payments for the rest of the time. And then folks always ask, how much can housing prices come down? Let's say rates stay where they are here or go up a little bit more and sustain themselves. It's going to be a matter of how long rates are here and how long they sustain this level. That's going to impact the housing market. Now, let's say they hold and they maybe go up a little bit from here. In my opinion, there's two classes to downside risk. Somehow, under $2 million in California now is a house along the coast or within 10, 15 miles of the coast, which is where the majority of people live here. So if you're buying a place under $2 million, you're probably pretty safe that you're not going to lose any equity on a move forward, regardless of what happens with interest rates, because there is no supply of housing. So the under $2 million crowd, you might be able to squeak out some appreciation in a rising interest rate environment. Call the 2 to 3 million crowd the same, but once you get above that 3 million number, you can start getting back on our end different varying appraisal values and levels. So basically, under 2 million, you're pretty safe. Over 3, 4, 5 million, you could have some play in there. If you're priced accurately, there shouldn't be more than 10% play to the downside, which on any given year, 5 to 10% up or down in the housing market's just trading and completely natural. We've just gotten accustomed to double-digit raises in home values and double-digit declines, for that matter, 15 years ago. So very limited risk right now in buying a property. And if it is your primary residence, please treat it as a utility. And above and beyond all of that, as we all know, everything is certainly cyclical. Okay, everybody, that is my show for this week. I hope you have a great rest of the week. Thank you for watching. If you need anything, please don't hesitate to reach out to me. Thank you so much.